Picture this. You're 27 years old, standing in a grocery store holding a $6 bag of fancy coffee, and you put it back on the shelf because you're trying to be responsible with money. You make $72,000 a year. You've got $1,800 sitting in a checking account, and your idea of investing is having a dusty Robinhood app on your phone that you downloaded 2 years ago and never funded. Your coworker keeps talking about her Roth IRA like it's some exclusive club you haven't figured out how to join yet. And every time you open a personal finance article, it assumes you've already got $1,000 a month to throw at the market, which you absolutely do not. So, you close the tab, put the coffee back in your cart after all, and tell yourself you'll figure it out when you make more money. Here's the problem with that plan. The math doesn't wait for you. If you're tired of financial content that starts with, "Just max out your 401k," like that's a sentence a normal person can act on, subscribe and hit the like button, because this channel runs the actual numbers instead of handing you a bumper sticker. Today, we're taking $100 a month, less than most people spend on unused subscriptions, and showing you exactly what it turns into over 10, 20, 30, and 40 years. We're talking specific balances, where the money actually comes from, and the uncomfortable psychological reason most people never make it past month 3. Let's get into it. There's a belief so common it might as well be wallpaper, that building wealth requires either a high income, a hot stock tip, or some turning point where everything finally clicks and you start making real money moves. That belief is mathematically wrong, and the Federal Reserve's own data proves it. 46% of American households have exactly $0 in any retirement account. Zero. These aren't people living below the poverty line. A lot of them are pulling in decent money, living normal lives, driving reasonable cars, and going on the occasional vacation. The gap between them and the people quietly building wealth isn't income. It's one concept they either understand or they don't. Compound growth isn't about how much you put in, it's about how long it runs. New Stern data going back to 1925 puts the S&P 500's average annual return at 10.48%. And here's the statistic that should stop you cold. The S&P 500 has never produced a negative return over any 20-year rolling period since 1928. Not through the Great Depression, not through the dot-com collapse, not through 2008. Every single person who bought a basic index fund and held it for 20 years came out ahead. So why don't more people do it? Because your brain is running software from 100,000 years ago that was designed to prioritize right now over later. Behavioral economists call this temporal discounting, and studies show your brain values an immediate reward roughly twice as much as the same reward in the future. That's not a character flaw, it's neuroscience. And it's exactly why 59% of Americans can't cover a $1,000 emergency even while earning above average incomes. The cost of waiting isn't linear. It's exponential, and that changes everything about when you start. Here's what $100 a month actually becomes at the S&P 500's historical 10% average return. The first decade. Planting the seed. After 10 years of investing $100 every single month, you've put in $12,000 of your own money. Your balance sits at $20,484. I know. Before you click away because that number doesn't exactly scream financial freedom, hear this. Only $8,484 of that balance is growth, meaning compound interest has contributed just 41.4% so far. You're still carrying the weight. Your money is barely off the couch. This is the most dangerous moment in the entire 40-year journey. Not because anything is going wrong, but because nothing looks like it's going right. You've been disciplined for a decade, and you've got $20,000 to show for it. Meanwhile, your friend just financed a $45,000 truck, and it feels like he's winning. He is not winning. But the scoreboard at year 10 doesn't make that obvious yet. The boulder is at the top of the hill. You just can't see it from where you're standing. The second decade. The shift you can finally see. 20 years in. Total contributions, $24,000. Account balance, $75,937. You put in another $12,000 in that second decade. Your account grew by $55,453. Read that again. An additional $12,000 from you produced over $55,000 in growth. The second decade alone generated more than 4.5 times what you personally contributed in that same period. Compound growth now accounts for 68.4% of your total balance. Your money has officially clocked in and started working harder than you do. In your first 10 years, your investments grew by an average of about $848 per year. In your second 10 years, that number jumped to $4,697 per year in average annual growth. And you didn't change a thing. Same $100. Same boring index fund. You just kept showing up. When people say start early, this is what they actually mean. Not that you'll contribute more money, that your money will have more time to replace you. The third decade, the number gets serious. 30 years, $36,000 contributed. Balance, $226,049. You crossed $200,000 on $36,000 of your own money. The other $190,049, which is 84.1% of everything in that account, was generated purely by compound growth. This decade alone added $150,112 to your balance, more than 4 times your total lifetime contributions across all 3 decades combined. If you started at 25, you're 55 years old right now, with $226,000 sitting in an account that now generates about $9,042 per year on its own under the standard 4% withdrawal rule. That's not retirement money on its own, but it's real, meaningful, life-changing money built on $100 a month. Now here's where the math gets genuinely brutal. If you had started at 25 and kept going to 65, you'd end up with $632,408. But if you waited until 35 and invested for the same 30 years, you'd have $226,049 at age 65. Same number of years, same monthly amount. A $406,359 difference because of a 10-year head start that cost you an extra $12,000 in contributions. You paid $12,000 more. You ended up with $406,000 more. That is what time costs. The fourth decade. The part nobody believes. 40 years, $48,000 in total contributions across 4 full decades. Account balance, $632,408. Sit with that for a second. You put in less than $50,000 of your own money over 40 years, and you have $632,408. The math says 92.4% of that balance, or $584,408, came from compound growth. You contributed 7.6%. The market contributed 92.4%. This single decade added $406,359 to your account, more than 8 times what you put in across all 40 years combined. At 4% withdrawal, that $632,408 generates $25,296 every year without touching the principal. That's a $100 a month habit you built when you were still putting coffee back on grocery store shelves, and it became a $25,000 annual income stream that outlives you. Why most people still won't do it. The 10% figure comes from historical S&P 500 averages, which means some years you'll watch your balance jump 25%, and other years you'll watch it drop 18%. 2024, the market returned 24.88%. 2022, it fell 18.04%. The investors who panic sell during the 18% years and pile back in during the 24% years are the ones who destroy their own returns. Dalbar's 2024 study tracked this precisely. The average investor earned 16.54% in 2024, while the S&P 500 returned 25.02%. That 8.48-point gap didn't come from picking the wrong stocks. It came entirely from behavior, selling when it hurt and buying when it felt safe. The market isn't your biggest enemy. Your reaction to the market is. The conservative case. If 10% makes you nervous, let's run 7%, which is closer to what a diversified portfolio, mixing stocks and bonds, has historically produced after inflation. At 7%, $100 a month for 40 years gets you $262,502. That's still over $250,000 from $48,000 in contributions. But that 3% difference in return costs you $369,906 over 40 years. This is why expense ratios matter more than most people realize. A 1% annual fee on an actively managed fund sounds harmless. Over 30 years on this kind of portfolio, it quietly eats $104,592 in growth that would have been yours. 94% of actively managed funds can't beat a basic S&P 500 index fund over 20 years. The financial industry charges you for underperformance and does it with a smile. Where this leaves you. Here's the full picture. $100 a month at 10% historical returns. After 10 years, $20,484. After 20 years, $75,937. After 30 years, $226,049. After 40 years, $632,408, with 92% of it never coming out of your paycheck. Starting a decade earlier is worth $406,359 on a $12,000 difference in contributions. Every year you wait costs you exponentially, not arithmetically. And the single biggest threat to hitting these numbers isn't a market crash or a recession or bad luck. It's you selling when it drops, pausing contributions when life gets loud, and waiting for conditions that feel more certain before you start. The math on this has worked for a century. It'll keep working, but it needs time. And time is the one thing you can't buy back. $100 a month is 3 fewer takeout orders. It's 1 unused gym membership. It's the streaming services you forgot you signed up for. The strategy is boring on purpose. Buy a low-cost S&P 500 index fund, set up automatic contributions, and don't touch it. The people who've done this for 20+ years don't look back wishing they'd waited. They look back wishing they'd started the month they first heard about it, instead of the month they finally stopped making excuses. You already know what to do. The only question is whether you start today or invent a better reason not to. Your future self is watching.